Welcome to Fintech Impact. This podcast is an exploration of the financial technology world, interviewing different fintech entrepreneurs about what they do, their story, and what their impact is on consumers, incumbents, and the industry as a whole. Here's your host, award-winning financial planner, university lecturer, and writer, Jason Pereira.
Welcome to Fintech Impact. I'm your host, Jason Pereira. Today on the show, I have a pioneer in the fintech space, Shawn Brayman of PlanPlus. PlanPlus is a financial planning software that recently actually purchased another interviewee, FinaMetrica. But frankly, what he does goes far beyond just basic financial planning. And this conversation got very interesting very quickly. Essentially, we spent a little bit of time on the financial planning software, but really we tended to focus on a couple of the key trends or the key initiatives that he's involved with. So we talked a lot about academic research in the space and how they're trying to integrate that into the software. We also talked about global trends and tech trends in general and what the future will hold for financial advisors, fintech, and consumers. And I found it to be a very enlightening and interesting conversation, as it always is with Shawn. So I hope you enjoyed this. And now, Shawn Brayman. Hello, Shawn.
Hello. How are things?
Things are well.
Yeah.
Good to see you. So, Shawn, tell us about PlanPlus.
So PlanPlus is Canadian-based. Companies started doing financial planning. When we evolved from, call it desktop to the web, we said the world's going flat. And so we built a multi-jurisdictional, multi-lingual, multi-currency platform. So basically a very global spin on financial planning that remains, I think, somewhat unique. We're very focused on research, client best practices, the profession that planning is trying to evolve into, as opposed to the anecdotal rules of thumb that have often evolved.
That we are,
out of the industry, and that people think then is how you do it, right? So obviously, I'm a bit of a geeky research guy, and we do lots of research. And I'd say that's kind of our focus. We're not a bunch of techies cranking out product. We're really domain knowledge experts, and probably the most experienced as far as financial planning in a global perspective.
So, end of the day, you guys are really financial planning centric more so than tech centric, which is a difference to other startups.
Totally, yeah. If you talk to my programmers, they'll say they're tech centric.
Oh, you need someone to code.
Yeah, yeah, exactly.
So we'll come back to all that, but tell me about the journey to start this, and what was the impetus for creating PlanPlus?
Basically, PlanPlus was actually a spin out from a larger Hewlett Packard ISV back in about 1985. So we'd actually started doing a planning piece for an insurance company. And at that point, there weren't a lot of planning tools in the Canadian market. There was one at
1985.
Yeah. GoBay was around, and
there was Excel.
Excel, and that was about it. So bottom line is, the company we're doing the work for got acquired by another U.S. company, who then disbanded the whole thing. They were just buying the policy book, and so they literally turned off Canadian operations and left us there with a half-developed, actually expert system-based planning tool, because I had done my early academic stuff in predictive expert systems. And then we ended up saying, okay, well, let's try to turn this into something. But it ended up, instead of being mini computer oriented in those days, it all ended up the market went PC. And so I kind of spun it out as in an early days. And then we had to trash the whole thing, rewrite it about 3 times, over the years. But so that started the journey. And so basically I've been going to planning conferences here in Canada since 1986.
How much change has happened, and is it enough?
So if I was going to summarize the journey, if you'd asked me in about 1990, I would have said, oh my gosh, financial planning is so obvious, so logical, take care of the client best interest. It's just the way the industry's got to evolve. And 25 years later, I'd sit here and say, ooh, there's still a fair piece of the journey that we've never made. I'd also say technically, too much of the story is the same now as it was a couple of decades ago, right? A couple of decades ago, I would have had a room full of financial planners that said, what we're after is an integrated suite with our CRM, our back office, our planning tools, and be able to deliver good advice.
Everything's
and
best in
monitor
class at the same time. So.
Yeah. So fundamentally, we're getting there, but it's amazing how poorly integrated a lot of things are, within both the tech space and the advisor space. So over the years, as I said, we basically went global and expanded. As you know, last year acquired FinaMetrica out of Australia because, again, we saw them as a best-in-class evidence-based risk profiling, risk tolerance tool, and continuing on our journey.
Okay, so lots to talk about there that I want to hit on. So the first thing you said is one of the things I want to hit on is that you said you went web. So you guys were very early to the cloud. Really?
Everything we do, unfortunately, we tend to be a little bit innovative and at what they call the bleeding edge, right? Yes. So we went to the cloud 2001. We probably started doing our first web-based version.
Was there anyone else at the time doing that?
Not even close, right? Because really with detailed analytics, people were doing it in spreadsheets or and a lot of guys, as you know, are still struggling to get off spreadsheets and desktop-based software because it's just, you didn't have the same capabilities on the web for interaction and so on. So no, we were very early.
So you were cloud before there was a cloud.
Absolutely. When we were fintech before there was fintech,
exactly,
right?
Yeah.
So we've been doing it for a while.
Interesting. Yeah. Now, another thing that's unique to your platform, or at least the conversations I've had, you very much, like you said, multi-jurisdictional. How many countries do you currently operate in?
So let me break it into two levels. So customer-wise, we have planners or advisors within channels or whatever, probably running around 20 to 30 different countries. We have other countries supported in the software. So basically, we have 50 countries roughly that we do all of the taxation, asset allocation, and so on for it. But it kind of scales up in depth. Some countries are simple, no taxes or flat rate taxes. And
that must be a dream to program.
Yeah, those are the easy ones. And then you trip over countries like the UK or Germany.
Or the US.
Or the US, like where basically we've had more time to complicate the world. Or Canada, where
every year it gets worse.
Yeah, new budgets and new ripple effect out to, well, now what are all the calculations we have to do here to be able to make the thing go? So it's not the same degree of complexity in every country. But so it's basic scaling from simple goal-based, if you will, with asset allocation and taxes up to, more bespoke integrated.
Fully cash flow based.
Yeah.
So, I mean, and again, I don't think anyone else that I know of basically touches you on that side.
There are other companies that operate in more than one country, but they usually take their program and they take their Canadian program and put it in the US, or their US program and they put it into the UK, or their Australian one and they put it in South Africa. But I've never seen anyone that's actually architected a global platform. So we have one code base that literally operates in every country on the planet Earth and for every one of our customers, from a small IFA independent advisor up to the largest bank.
Yeah. And when, one of the things that struck me when I took the CFA and the portion on tax planning at the third level, you realize just how few tricks there really are. There's a certain level of first principles that apply to taxation and planning around the world, right? So there's only certain types of incomes, only certain types of investments. There's only certain types of methodologies for taxation. Yes, we can convolute them with exemptions and all kinds of other things. Yeah. But at the end of the day, I always thought to myself, it's possible to actually do this, to actually basically build something on first principles and extend from there like you have. So I commend you on that. Also, it's so funny you mentioned the entire taking from one domicile to another, because that's a classic business mistake in so many ways. I remember a company who will not be named that basically tried to do the same thing in Canada and came up here, and I was trying to ask them, I was like, well, why is critical illness insurance not on here? And they thought like, oh, we have long-term care. Like, no, that's not the same thing. Is it disability? No, it's not. Like, it was clear that they literally had no respect for the fact that they were in a completely different domicile with a completely different set of rules and different products. They were just basically thinking they could pour it over. And that's...
Yeah, exactly. Well, exactly. Lots of people, again, you look at a lot of the guys from the US that have tried to come to Canada and they kind of go, well, what's an RSP? Well, why doesn't it act like a 401k, right?
Why isn't the world exactly like us at all times?
Exactly. I mean, there's a currency other than US dollars. So I think one of the advantages coming from Canada is that because we're Canadian, we work with more than one language right out of the gate, and our tax structure with our provinces, civil law and common law, you automatically see the world a little bit different than all one cookie cutter.
Exactly.
And that laid the foundation to then start saying, okay, as we kind of worked our way out, I think we might have had maybe a half a dozen countries on our desktop version and went, this is nuts, right? And then again, as we evolved the architecture, we said, okay, what have we learned and how can we make it then expand out? And quite frankly, I see the real opportunity just kind of coming to the fore now. So in the same way that 20 or 30 years ago, I would have said it's obvious planning will take over the world in the next decade.
Incentive systems haven't let us get there, but it's getting there.
Lots of things didn't keep, the compensation didn't let us get there. The tech didn't let us get there. There's lots of reasons why.
Capture didn't let us get there.
Absolutely. No. But what we are seeing now is that with the flattening that's coming in large FIs, financial institutions, right? Whether it's asset managers or whatever the case might be, you finally have the financial world starting to look at system portability across different countries, right? Because somebody in the US doesn't want to have to build an entirely different system to deliver in the UK. No. Assets and portfolios are more portable, but getting into the tech, it hasn't been.
No.
So I'm really excited actually about where that leaves us kind of looking forward.
So a couple of points to get to. So FinaMetrica, from your standpoint, the view, great conversation with Paul on that podcast. From your standpoint, what was your reasoning or impetus for the actual merger?
Couple of different things there. One is that we had actually done back, and it's probably over on your shelf there, risk is a 4-letter word with George Hartman was, so George and I started working together here in Canada, collaborating back somewhere in the mid-90s, give or take. And we had done a bespoke risk profiling, risk tolerance questionnaire. And basically, when we came across FinaMetrica, we said, there's something better than bespoke. There's an actual science here, right? So we, without too much trepidation, abandoned our RPQ, which was actually not too bad, right? But it was like everything else in the market. It was just us using our thoughts, right? And we brought in FinaMetrica. So now probably 60 to 70% of our corporate clients are using FinaMetrica.
Oh, wow.
So
that's a vast improvement. My goodness.
Absolutely. Right. And it takes a while, right? It takes a while for people to get over there. Oh yeah, but we have this other one that we built a decade ago.
With anything.
Yeah, exactly. Science, what's science? Yes. It's just, this is for the regulator, right?
No.
So one, it was a good business fit there. Plus we operate in a lot of the same countries. So we've been collaborating in Asia and other countries. And again, the fact we have a global platform and their kit operated globally, good logical fit. Culturally, we were very aligned. Again, we're both strong proponents of science, research, making sure it's not just what you think is good, but that it's based on scientific evidence. So that was a good cultural fit. And it helped actually expand out our network. We already had small offices in Asia and so on in Europe. But what it did is it kind of, it allowed us to complete that network. So we now have a bigger body of staff in Sydney that can help us in the Asia Pacific region. I don't have to ask my developers, or guys to stay up, not usually until the late hours of the night. Yeah. So it basically was a good business fit. We had common customers. We already had an integrated tech. Was something that we believed in philosophically. And I'd known Paul and his other co-founder in FinaMetrica going back, a guy named Jeff Davies, who was actually, Paul was always more the marketing voice and Jeff was kind of the analyst behind it. So when Jeff's now 72 and wants to be surfing in Australia, looking after his grandkids.
Who can blame him?
Yeah, exactly. So fundamentally, we said, here's a great opportunity. We'll monetize Jeff, get him out of the business, wrap the two things in together, and Paul became a shareholder and director of PlanPlus. So really good fit. It also gave us more scale, from a revenue point of view, sales and marketing point of view, to be more responsive both to small IFAs as well as larger corporates. It was you don't find those types of things often where it was such a good fit technically and business-wise.
Good. I mean, he seems happy from the conversation I had, so that's great. Mm-hmm. So one of the things you mentioned in terms of trends, and I've discussed this with other people on the podcast, is the move towards integration. And, the proliferation of an APIs is kind of standard operating procedure now. And we're seeing, in the US, I think it's probably the most predominant example. You can literally go to the FPA conference and pick 5 different components at random, yet they somehow all manage to interact with APIs to varying degrees of success. Is that something you're seeing elsewhere in the world, or you think is something that what are your concerns around that entire issue? Because there are concerns around information sharing and how that's done on a secure basis.
Yeah. The short answer is yes, the tech is evolving. But again, one of the things I would say is that if you went back 20 years ago, people had technical mechanisms, right? We evolved through, DLLs, and we evolved through XML and web services payload. And so fundamentally, technology's known how to integrate for decades. It's not a new invention. What is different is you have to look at what is the reason for integrating, and is the market at a point where, in effect, it's scalable. If 2 companies make 2 APIs, they don't abracadabra talk together. Someone's going to write all the interfacing for my API to deal with your API, right? Which is no different than what we had before, whether it was database to database, whether it was through other interfaces, right?
But is that just the move towards modularization of components versus full stack integration?
Yes and no. I think that there's a bit of both. And let me say that I think what we'll see actually, the U.S. has driven it for commercial reasons, partially because the U.S. was already more fragmented, right? If you look at the Canadian marketplace, we actually had data standards, which meant that it was easier to get stuff universally, which caused, in some ways, I think they're looking in backwards, maybe some good and some bad. In the U.S., you have 5 big custodians. Nothing speaks the same language. Everything's about, so the business need to have APIs so that if I'm the CRM or whatever, I can suck it in from all these different places and different standards was much more at the forefront than what you see here in Canada. I think one of the big changes, though, actually, that I'm most excited about is if you look in the European market space, the whole redefinition of who owns the data from a regulatory point of view fundamentally changes the whole reason why APIs exist, right? I think. Because what's going to end up happening is if the customer owns the data, not the bank.
Which technically we do in Canada, but technically it's also given to us in the most difficult way possible. But
right. Yeah. So what's happened is you actually have API data standards that have been declared that all the banks, all the financial institutions must adhere to. So it's not that every bank has to give the client the data in whatever format they want. They have actually said, here's the mechanism by which that's going to happen. Now, all of a sudden, think of a gazillion vendors who have access to the same data that the banks have, all the banks. So what does that do to aggregation? What does that do to the ability to take out all of the intermediaries that have been sucking at the trough in a very profitable way for many years? So all of a sudden, the nature of lending, right? When you can have automatic access into the client reality with apps that can tell you, will this guy pay or not?
Yeah. It's like, what's his behavior been? How fast is he spending? Exactly. Where is he spending at?
So do I need to use a credit card as an intermediary device for credit, or can I be a retail vendor and be able to validate that you're actually a good bet? And I just give you the credit. So what happens with FX? What happens? So if you look at the entire space, we are entering in, it goes well beyond just traditional apps or platforms talking to each other. We're going into a time where I think you're going to see a fundamental shift in a very positive way, potentially, a necessary redefinition of what the underlying backbones look like, if there are even backbones, right? So are you going to a distributed framework now where the client is legitimately at the center, where anybody who has data on the client, it needs to be shared in a consumable way, and that anybody who wants to build apps to make the client's life better can get at that, right? So that's a paradigm shift. And we've already seen, so Europe, the UK, I think Japan, Australia have said they're now going to adopt the same standards. So this is a really cool shift in how the world is going.
Oh, absolutely. I mean, you think about the mind-blowing number of possibilities for the most basic of functions that now have the potential for a revolutionary new market product. It's unbelievable.
Absolutely.
Like every last piece of information being that easily accessible and being able to, you said right there, why can the, simple app that a retailer would be able to use to extend credit based on information and terms. Like that's just, that never even crossed my mind once. I never even heard that concept, but frankly, that is incredible. And if we were to sit here for an hour, you probably think about a billion of them.
And people are like that's, so when you look at fintech not at just the buzz that's created by the investment arena and whatever, and say, okay, well, what is fintech really? What it is a redefinition of how we can apply technology. And let me say, there's a lot of bullshit, excuse my language, in this space where anybody who sells to a bank calls himself a fintech, right? And like, it's got nothing to do with fintech. It's just, that's your market, right? But when you look at the fundamental nature of how we manage, manipulate, understand money in a person's life, right? And what we can do about that from a product point of view and so on, that's where you're seeing a lot of people who are stepping out of the traditional box to say, okay, we're coming at this a different way. And so one of the things, again, we're trying to do is say, yes, there are traditional paradigms for doing financial planning. And yes, we do it in lots of places with lots of advisors, and that's all cool. And I think the things that we do when you look at the whole, call it suitability journey. Do you really know the client behaviorally? Do you understand all of the other parameters that come into play, objective parameters, analytical parameters, like what do they need? The planning side, what's their capacity? How do I move all those things together to come up with where I think the client belongs? And how does that map into my product? Like you look at the whole suite, I think we rock, but how do you step out of the box and say, okay, think about all the things now where the data that as a planner that I need about the client is actually sourceable.
Oh, I know. Just simply being able to plug, look at the inroads that eMoney's made in the US based off of one trick, data aggregation. Right? But that's just version 1.0 of data aggregation, in my opinion, because you're throwing it up on a dashboard. Well, congratulations. But what about the extensions of that whereby, okay, the plan says you're going to contribute X when your bonus comes in.
Right.
How about the bonus comes in, there's a behavioral cue that's flagged that automatically gets you to basically click yes to make that contribution and actually fulfill the plan. Right.
Yeah. So fundamentally, if you look at that, and I think that, there's two spins from it. So we already do a simple thing called Plan Track, right? Which is part of our kit where we're looking at the plan said you're saving, you're supposed to withdraw at this time, and is your actual behavior mapping to that? If not, better tell the advisor, oh, sorry, Jason's gone AWOL on us, and let's pull him back in and reevaluate the plan, or you tell the client, right? So that's pretty straightforward. But where it even becomes more interesting is where you see all of the big institutions focusing is, nudge, right? So
big fan of behavior.
What is not the full plan, but the one thing that I look at and I nudge you to do, right? Save this, pay down this, do this. And now picture you're the consumer and you've got 100 apps that are all nudging you in different directions. Has nothing to do with your financial planner. It is every institution and FI you're dealing with.
On their individual basis, who streams. There's a role for advisors in the filtering out of that to basically create the framework whereby here's what the actual important 5 things are, or the 6 things are. And this is how you get to where you need to be.
Exactly. Right. But the reality for the consumer is going to be much more discordant in the future. And it was already bad now, right? With multiple advisors pointing and pushing and pulling in different directions.
Integration, different directions.
Now you're opening that up by an order of magnitude, which offers to the advisor, I think, some really unique opportunities in coaching and working with clients. But it also means that advisors need to step out of their box from a technology point of view.
Which is going to be incredibly difficult because most of them have
exactly
fear of technology. And part of the reason for starting this podcast was to pull back that veil.
Right. But they're too late. Like whether they like it or not, the technology is out of the box. The consumer is not going to wait. So people were afraid of disenfranchising themselves by letting the consumer see too much. But the road to success...
Friction is not a barrier. It's not a way to retain business. It is a way to make your clients angry.
Yeah. No, and I think that's going to be a challenge for the advice side of it going forward, is how do you embrace the use of the technology, empower the consumer wherever they can or want to be empowered, and be able to keep a hand on enough of the strings that you're the person that they're counting on to sort out, filter the 100 bad nudges to say, actually, here's the course that you should be following. And you can't do that in isolation of the technology. So I think that because we've always come at the world holistically from a planning perspective, right? That's the filter that you almost need to overlay across all the nudges to almost validate is what's happening here. Behaviorally, it might be nice to nudge the client, but how does the client say it's the right
death by
thing to
1,000
do?
cuts, it's slow too much.
Bang on.
And it's funny because, so much of what you're talking about just kind of reminds me of all the advisor complaints about difficulty in marketing to millennials, right? In that there's a real disconnect, right? You have digital natives who grew up literally with all of this, and you have the classic advisor of trying to sell them a product, or maybe they are doing planning, in which case here's the static paper plan that I'm going to do once in a while. And it's just not resonating with those people because they're used to immediacy. And you know what? It's not impatience. It's right. Because frankly, in a world where you can get a car pickup or any food delivered from any place literally in 20 minutes, or Amazon dropping off whatever I buy online within the same day, why in God's name does it take forever to pull together all this data for a financial plan?
Let me give you a quick kind of observation as to why. And that is, quite honestly, if you went into, I just came back from Finovate on the weekend in Europe. It was good. Yeah. And some good presentation, good observations, right? But may have heard that, for instance, Barclays Bank, I think it was Barclay or Lloyd's, one of them just announced $2 to $4 billion to revamp their stack. And what people don't understand is that some of these institutions still have IBM mainframes where you load up punch cards, green screens. And in a world where not only the consumer expectation, but the regulator is now saying you need to notify the client within X hours in the event that this happens. Now, some of the things the regulator is saying I think are bad, are going to trigger bad behavior, separate dialogue. But the bottom line is the entire stack that most of the big banks on the planet Earth are built on are batch processes that cannot do anything but run overnight. And so they've got to rip the foundation that's been sitting there since the 60s and the 70s.
It's a monumental task.
Big time.
It's interesting. And it reminds me of a story, and Wealth Simple, who was in here previously and talked about this. When the new regulations in Canada, CRM2 came out, and the changes that had to happen, the financial statements happened, they put 2 developers on it and got the problem solved inside of 1 day. Meanwhile, every bank in this country had like 2 years to get it right, and the statements still went out late and with errors 2 years later. Like, it was a monumental task. And it speaks to the nimbleness of current systems versus the antiquated ones, but it also speaks to the fact that why is it taking so long to try to move off these legacy systems?
The answer is obvious, is that everybody's always looking at tomorrow, not yesterday. If it ain't broke, don't fix it, right? So, and if you go to try to fix it, as anyone who works in the tech world knows, you go to fix it and unintentionally you break something else, right?
It's true.
So the bottom line is, as
that
long
technical
as
debt just keeps on building. And now it's to the point where it's this monolithic monster that where do you even start without basically burning everything to the ground?
Yeah. And that's the piece that, especially with what we're seeing in the whole, again, data transparency and the client owns, that's calling the question that they can no longer just ignore that debt. But what it's going to do is in effect, I think, end up creating, again, in the financial services sector, they're going to be trying to figure out how do we now, if we got to revamp it, where do we go not to catch up, but to see where the universe is going beyond this point, right? So what does the world look like 5 or 10 years from now, where, as we said, the client's the center of the universe, and there's a gazillion guys that can see everything about the client that he wants to share.
Well, it's already happening. We're seeing disaggregation of any number of services. I mean, you look at all the startups, they're all picking on like one thing a major bank does, right?
Yeah.
And they're doing it infinitely better than that bank does.
Yeah.
And when you stop caring about the working with the large financial institutions for the concept of security,
yeah.
And if you look at the generational shifts, the concept of security is very different to younger people than it is to older ones, where they were like, I want the big steady bank that I know that the branch is on the corner and all that.
Yeah.
And we all have the same protections. We all have the same CIDC, CIPF, all of that sort of stuff. And you realize that a lot of that's just a smokescreen in a lot of ways. It basically allows them to sit back and do nothing. So that's already happening. And then you look at the players like Amazon talking about getting into checking accounts. I mean, I don't know how you're not absolutely terrified if you're working at these major institutions now. I mean, sure, a lot of them are like 5 years away from retirement.
Yeah.
You know, that's what I commonly hear. It's like, yeah, I'll be gone before that's a problem.
Yeah.
But that short-sighted thinking is going to sink these traditional hierarchies.
You know, again, like I think not all of them are quite as complacent. I think the fear is
I'm used
real.
To Canada,
but
sorry.
But I think the number of types of opportunities and the rate of change. I was just in India a month ago, right, for a conference there. And as I was there, they were talking about, I don't know if you'd heard about what they did about currencies, right, where fundamentally there were massive gray markets.
Well, they banned certain notes?
Any notes over a certain amount, you had a certain number of days you could bring it in. They gave you an amnesty. So as long as you could prove that the money was legit, even if you hadn't reported it, no fines. Yeah. But fundamentally, all in a matter of months, they took all of the black market currencies on the planet, on their planet, they're part of the planet, and they said, if you can't walk into a branch or a proper institution, hand over the dough, then it's garbage. It's toilet paper.
I know. It was hilarious. I mean, you heard stories about like people buying entire buildings with like briefcases of cash.
Yeah.
And just to keep the record off just to keep off the government's radar. Yeah. You know, you can't evolve into a westernized society with that sort of nonsense.
But I think the idea of staying off the radar is becoming progressively at every level more difficult, right? The concept, I mean, there was just a report the other day about how the forensics being applied to blockchain now means that anonymity is not a true value proposition of it anymore. So one of the things you touched upon earlier, and I want to reinforce, I want to go back to this. You talked about support of academic research. I know you guys have supported a couple of studies. I've been privileged enough to sit and look at the shameful results of one or two of them, but shameful advisors' parts, not on what you guys did. But can you speak to that and like what you've done in the past and why it's important to you? I think like anything, as I said, I make no apologies. I'm a geeky academic type, right? And it started in 2007 when I heard everybody ranting about Monte Carlos and sequence risk, right? Yeah. And quite honestly, I had a physics background to start, went into predictive experts, so I was a numbers kind of guy, and I'm going, this doesn't make any frigging sense, right? And that's when I won the first research, whatever it was, the Financial Frontiers Research Award in those days. And then I kept looking, and every time I saw something that would bother me, where people would be doing something as if it was the right thing, and no one peeled it back to say, well, is there actually any evidence that this is true or makes any sense or whatever? So even as late as 2-3 weeks ago, we were at the CFP Board's academic colloquium down in DC and won another Best Paper Award with the work we've been doing with the University of Georgia.
So that's the one on allocation.
Right, on professional judgment, right? So basically everybody, so we know how to measure risk tolerance, right? I think that part, it is a science. It's been operating for 20 years. Most, you could go in and go to Google Scholar. You'll find 200 peer-reviewed papers all using FinaMetrica data and so on. Yeah. That rocks, right? Then you look at how do we combine and make the trade-offs for a client between need and capacity and education and time horizon and tolerance and all the rest of it. And that's research where this came up when we did the work with the OSC here in Canada, and found that, well, nobody's really defined how you do that. And the regulators called it professional judgment. responsibility. So we said, okay, well, let's see if there actually is something under this. Bottom line is what we found is randomness.
Yeah.
Most advisors, they all disagree. Some believe in tolerance, others don't. Some believe that it's all capacity, others don't. So the truth of the matter is they're all bringing their biases to the table. And the way I try to frame it is if you walked into 200 doctors and they all brought their biases instead of science, you'd walk out with 200 different diagnoses. That's not a profession, right? Yeah. So if we want to be a profession, that's why we say, even if we don't like what we find, you got to open it up, look at what we're doing and say, is it true? Is it working or not, right? And not get defensive about it. We don't have to apologize for where we're at, right? There hasn't been research in this space until now. So that's where we're trying to say.
I think someone pointed out that when the question was asked, like, what allocation would you give for the person in this case? I mean, there was the two questions that were the identical questions separated by one question, and they were different results. And that was shocking. And then the other one, the best fit happened to be 100 minus your age, which I literally, my hands went into my face. Like, it was terrible. I'm doing it right now because it's just so frustrating.
Well, so that was, we had 5 scenarios. 2 of them were identical in every way. Same tolerance, same need, same whatever. And the only difference was the age of the client. And fundamentally what we found is when wrapped through to what would be the allocation. And the name of the paper that won this award is called Do As I Say, Not As I Do. Because what came out of the research is every one of the advisors said the right things. They would say, these are the pieces we need to consider. They all get it. They've all read it. They all understand it. But then when you look at what they did in action on the case studies, it wasn't the same thing as they articulated in the open. And so that was exactly why we do research. It's why we try to say, no one's saying that the industry is perfect, but let me say that there are lots of financial planners that we work with. They care. They care about their clients. They care about the profession. They're trying to do the right thing. Mm-hmm. But a lot of this stuff, again, it's still driven by broker dealers, sales channels, compensation.
Where's the incentive other than there is an incentive. You do things properly. I believe business follows from it. And that's been my belief.
Absolutely.
But in general, when you're starting out, or you're just basically trying to work through and be an advisor to sustain yourself, the reality is, where is the incentive towards learning all this academic stuff? Like, there is nothing. Your incentive is to take shortcuts, and especially the ones given to you by the broker dealer you're working with.
Absolutely. It's hard work.
It is hard work.
If you look at it, financial planning is hard work compared to going out on the golf course and selling some mutual funds, right?
Which is why very few people do financial planning.
Exactly. So how many people in Canada, with CFPs actually do what you would consider financial?
That has always been a major problem.
Take it the next level. And a lot of the ones that even do good planning or try to do good planning, how many of them have ever in their life picked up a research journal, right, in the field of financial planning and read anything that would be considered?
We don't even have a journal in Canada.
I'm very aware of that.
At least the Americans can at least claim they have the Journal of Financial Planning, which I do get.
Yeah.
But we don't even have one.
Yeah. So I think it's part of growing up as a profession.
It is.
Right. And I think that the dissemination, there is actually a lot of good research happening, but it's not making it through to advisors. Again, I go to a lot of conferences globally.
Okay, so you go globally. I mean, there's places that are better for that, right? I would think Australia, the US, and the UK probably are further ahead on that and disseminating the information and making it more mainstream.
UK, I would say not so much.
Okay. US,
yes. But again, there's still the problem of disseminating and consuming are two different things, right? Enough. So the Journal of Financial Planning, it's structured so it's easy for an advisor to read. There's the Financial Services Review by the Academy of Financial Services. It's been around for 32 years. It is the grandfather of academic research in this space, right? It goes out free to everyone who has a member of FPA in the US. And
how am I not getting this?
You are.
I am.
You are. But that's exactly my point. So if you look at there's an app you get for the Journal of Financial Planning, and in it, you'll find a link to the FSR, the Financial Services Review.
I will have to look harder.
And nobody, every time I talk, people don't even know they're getting it for free. And this is a quarterly peer-reviewed.
If it doesn't show up in my inbox, it doesn't technically exist.
And think about this. You are one of the bright lights as far as actually caring and digging and whatever. Yep. Now take that out to 25,000 guys who are just trying to run their business, who go to conferences and what they hear are product pitches 95% of the time. And why is it so frigging hard to turn the ship? Boy, we got a lot of momentum, right? And let me say in Canada, it's even worse. Like I was in a really embarrassing conference.
You're not going to get any disagreement with me on this one. Go ahead. Really embarrassing conference. I got to hear this.
In Mumbai, India, of all places, right? You go to India.
Oh, is this about how they banned embedded compensation and we haven't?
Well, no, I'm not even going to go there yet. Like that's a whole separate thing. No, this is indirectly, it ties to it. It was actually a Morningstar presentation, believe it or not. And they had done a global review of fees and costs of all of the markets that they're dealing, maybe 20, 25 countries. Canada is in the bottom 10% on the planet Earth for what we charge as embedded fees. In
fairness, though, and I will, because I actually know the former head of Morningstar Research for Canada, who actually refused to put his name on a report. Yeah. They failed to compare apples to apples on that one. So Canada typically embeds advisor compensation within their fee structures for mutual funds. Yeah. And but when you carve that out and compare it to domiciles like the US and elsewhere, we're much more similar. So part of it is, I think, fiction, but the reality is that the perception is such that people will claim Canada's amongst the highest fees in the world. And that's a problem in itself. The perception is a problem. Yeah.
Well, and again, I think that at the end of the day, whether we like it or not, follow the money. And even with well-intentioned advisors, how you get paid impacts people. It's true everywhere on the planet.
Wow. Incentives somehow have an effect on behavior.
What a surprise. What a surprise, right? So say what we will.
Actually, funnily enough, that was the exact conversation I had with Doug Cummings. For those who don't know, he wrote a report. Was it for the LSE? Anyway, so it was about how the impact of fund compensation on advisor behavior. Yeah. And he said he got a lot of negative slack about it because advisors hated the findings, but it was all true. And he said, lo and behold, compensation affected behavior. What a surprise.
Yeah. This is not rocket science.
No, it's not.
So the bottom line is Canada. I love Canada. Every time I come home, I look and I think we are one of the greatest countries on the planet Earth. I think that our stable financial institutions and the fact that we got through 08 more painlessly than most countries have allowed us to continue on the illusion, right, that all is well. And let me say, and I've ranted about this for ages in conferences, right now, it's down to, if you look at the MSCI world, the financial services space is down to 18% of the global, right? Yeah. It is more than oil and gas and healthcare added together, right? It is more than all consumer discretionary spending and most of the non-discretionary added together. So in what reality is it ever appropriate that playing with money,
the friction cost
is 20 plus, it used to be 24% before, around 08, right? Or before 08. So that's got to come back. And if you went 40 years back, it was 6 to 8%. So the problem is people now think that what we have is reality. No way. No. This is something that has evolved over a short period of time, a matter of decades. It is not reality. And the pendulum naturally has to swing back the other way. It has to.
If not, the trend line says that everybody will be working for a bank, which it feels like that in Toronto sometimes.
Yeah. And I'm somewhat optimistic, that what's happening now with the access to information, with saying this is not owned by the FIs, it's actually, I think we're seeing the beginning of breaking down some of the walls that may in fact force the financial institutions. You're going to see a loss of advisors, those that don't up their game either as...
But that's worked well in every country that's ever done it. So the UK, Australia now with the proposed rules on advisor competency, only 25% of advisors meet the competency test. You know what? You leave behind the people who are more competent, better trained, and hopefully run better practices.
Yeah.
So the quality of advisor automatically by average increases because you get rid of the other ones. And then on top of that, now you have a new bar for new advisors to meet, which means that they're more likely to meet a professional criteria.
Coming in, absolutely right. Yeah. So
we're afraid of that here for some reason.
Well, you know what it is everybody, any kind of change, the immediate argument is, oh, this is going to be bad for the economy. We're going to lose advisors. We're going to lose this.
Yeah. If the argument is such, and this has always driven me nuts when they talk about the amount of job loss in Canada, is, you know what? Well, if the only reason that those jobs exist is through lack of disclosure and low bars for competency, then we have a real problem here. We're extracting rent from the population in a way that is not ethical, quite frankly.
Totally. So, on the one hand, I'm really excited about the time that we're coming into now. I'm frustrated when I travel and embarrassed sometimes by Canada, right? Everybody loves Canada. I feel the same way.
I come back and I'm disappointed by the ecosystem I come back to. Thoroughly disappointed.
And it's not about the advisors. I've had people break down in tears right after I've presented or whatever, because people care. A lot of the advisors really care.
But it's the ecosystem doesn't give them the success to win.
The ecosystem is broken in our messaging, and that until that changes, all the rest of it is
And you mentioned George. When I sat down with him for lunch for the first time, he said, "What's your biggest concern in your practice?" I said, "Industry structure." And he looked at me. I'm like, "I'm guessing you never had anyone say that to you before." He's like, "No." So I went on about the ecosystem and compared it to around the world and what's necessary for this profession to get to where it needs to be.
Yeah.
And you know what? He basically said, "You're absolutely right." And it is. Yeah. And we're clearly one mind on that. So before we close out, talk to me. Let's go back to the company itself. So I mean, the great thing about this conversation is that you and I both have I think a great love for trying to understand this as a profession and want to see it go certain places.
Right.
But let's go back to PlanPlus. In the future, what's in your development pipeline? Like, what is it you're excited about with the product that's coming up?
Oh, wow. Boy, there's so much that we have on the go at the moment. Some of the research we're doing, trying to tie more on the behavioral side. And I think there's a rabbit hole there that the world's going down that's very dangerous. Because fundamentally, if I was going to phrase it, how people behave, system one, system two thinking, right? So our job is not to figure out how people behave with system one thinking and then try to make that the reality to provide. Our job is to give them good advice with system two brains and figure out how to keep them from making the knee-jerk bad reactions, right? So what's happening is everybody's behaving as if we don't have an intellect, right? That fundamentally these behavioral pieces that are built in, we've got to design our solutions and design everything as if
people don't have to think.
So people don't have to think. And that's wrong. Sometimes you have to think to do the right thing. Otherwise, you're going to drive people into a box where they will be unsuccessful. Yeah.
So creating zombies that follow your path.
Exactly. And so some of the areas where I think we're really looking at the world in a different way is we're not throwing out good advice. Good advice is good advice. We want it to be better advice, right? But understanding human behavior is an important part of the puzzle, but they have to live together in a very healthy framework. And it's not by saying we're going to figure out behavior and take advantage of it to sell the shit we want. Yeah. Excuse my language again. Right. But rather, how do we give good advice, direct the client in proper professional ways, and we're cognizant of human behavior and avoid allowing it to derail what is the proper, thoughtful future of that client or consumer, right? And so I think some of the work we're doing there, we've got, at a very tactical level, we have some things going on, but I think quite frankly, we bring, as we always have, a very different vision to the nature of where this space needs to evolve, right? And we've always been customer-centric, family-centric, looking at it from that perspective. So I'll kind of leave it at that.
Fair enough.
Well,
thank you very much, Shawn. This has been great. So thanks again for coming in, and I hope everybody enjoyed this.
Pleasure. It was really good to be here. And good luck with your podcast.
Well, thank you.
Excellent initiative.
And that was my conversation with Shawn Brayman of PlanPlus. I hope you enjoyed that. We went down a lot of rabbit holes and kind of got sidetracked quite a bit, but I think it worked out for the better. And with that, I'm your host, Jason Pereira. Join us again for the next one. Take care.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on iTunes, Stitcher, and Google Play, or find more episodes at fintechimpact.co.